All right, I see some familiar faces in the group. Wonderful. Welcome back. If this is your first time joining in, welcome. We're really excited that you're here. I think we're going to go ahead and get started. Formal welcome. Hi to everyone who's joined in. Welcome back. This is our Money Counts webinar series. This is the second to last session of the semester, which is like really hard to believe that it's almost the end of October already. Whew, okay. Thank you so much for tuning in. Today, we're going to explore how you can leverage saving and investing to help you reach your short and long-term financial goals. So really exciting stuff. My name is Sarah Metzger, and I'm a specialist for the Sokolov-Miller Family Financial and Life Skills Center here at Penn State. I'd also love for you to take a second to introduce yourself. I'm going to give my colleague also a chance to introduce herself here too, because she's on the call as well.
Hi, everyone. My name is Becky Moore. I'm happy to be here with you today, just hanging out and helping Sarah host.
I love that. Just helping Sarah host. 100%. Becky's going to be in the chat helping to facilitate questions. She's going to share out resources. So keep an eyeball on that as we kind of move through things here today. While you are filling out the poll on the screen, letting us know who you are, I do want to make a couple of quick notes. First off, and I have to say this, I'm so excited to be able to say this. I want to give a really huge shout out to our financial literacy student ambassadors, Aiden Kamowski and Lindsay Dermata, who put in a ton of time into making this presentation. They are wonderful. They're part of a wonderful student team that we have here at the center. And we are so very grateful, yes, for everything that they've contributed for today's session. So kudos to Lindsay and Aiden. I also want to point out, if you didn't hear, this webinar is being recorded. It should have notified you when you hopped in. So just kind of keep in mind, if you have to hop out early, no biggie. We are going to post this webinar, the recorded version, to our brand new YouTube channel. And I do believe that Becky has the link for that, so she's going to share it in the chat. I'm really geeked about it. It's really coming along. There are a few videos that we have already out there. Take a look at the playlist, listen through when you have free time, and really like maximize that and enjoy it for yourself. I love it. Super excited. Okay. All right. And I guess the last thing I'll say, I mentioned that Becky is going to be in the chat. She'll be there kind of fielding questions that come up as we go through, but we also have the Q&A box open. So if you want to submit a question anonymously, Becky can answer it there, or we'll come back to it at the end of the session. We should have plenty of time here today. All right. So without further ado, then let's go ahead and get started. So we're here today to talk about saving and investing, and to really kind of get us all in the mood and mindset, I want you to head to the chat, and I want you to finish one of the 3 sentences that you see on the screen here. By doing so, I really hope to get a sense of what motivated you to show up today. So dealer's choice, I feel blank about money, something fun I've saved for is blank, or investing is blank. And maybe it's and. If you want to fill out all 3 sentences, by all means, don't let me stop you. But let's see. Okay, I feel confident about money. Investing is intimidating with an exclamation point. Investing is terrifying in all caps. Okay, I really appreciate your honest answers here. Investing is what I've never learned. Well, that's going to change here today. Investing is scary. Something fun I've saved for is a car. Okay, cool. Checking in on a different sentence starter other than the last one on investing. So I like it. Okay. Investing is necessary and scary. So it's kind of like this balance between like, I know I should be doing it, but it makes me a little bit uncomfortable. So how do I proceed into this world of discomfort successfully? That's what we're here to talk about. Good. All right. What else do we have here? Oh, lots of engagement. I love this. Insecure, feeling insecure about money. Okay. Um, Hopefully we can help to change that. Feeling curious about money, saving for retirement, and thinking that investing is important and confusing. Okay, all right. Feeling excited. Something fun that someone saves for is tattoos. Ooh. I've never gotten a tattoo, so I don't know the joy of getting a tattoo, but I hear it's pretty exhilarating and not cheap. So I can understand the need to save. Okay, all really good responses. You all are blowing me away with this engagement today. I really appreciate it. Let's keep that up. If you have questions, please send them through the chat, or if you've got comments, you've got advice, resources to share, like this isn't a community learning space. So I want you to take full advantage of it, right? I'm guessing, I'm not guessing, like I'm looking at your responses and I see that a lot of the group is coming to this space with some reticence, like not feeling totally confident with what it means to invest, looking to learn more. I'm really glad you showed up today because that is what we're here to talk about, right? I know that you want to be able to live a financially healthy life, and that saving and investing, they're both really good money habits to help you boost your overall wellness. But I have to say, they're only two of the many healthy money habits that one should adopt. And if you've seen any of our other presentations, this is going to look familiar to you. So let me give you an example. In order to save money, you first need to create a budget that accounts for saving a percentage of your income each month. This is why you see on the screen here, right, that the base of our ladder is rooted in budgeting. That, before you endeavor to invest and grow your wealth, which we're going to take you right up the ladder, right? It's the highest rung of the ladder. You take specific steps to increase your financial security first. And I really do want you to keep that in mind as I move through these slides. I'm going to break down key ideas and helpful action steps that you can take to save and invest. And I hope that the information I share with you, that you take that into full consideration when thinking big picture about your finances. This is not a webinar in isolation. It is one piece of the puzzle, and I want you to keep that big picture perspective in mind. All right, so let's kick off with a quick conversation about compound interest, since it's a big reason we love to save our money. Here's how it works if you are not familiar. So the cash that you save, either in a savings account or an investment account, it's earning interest. So that initial cash deposit, it's known as principal. And after you make that deposit, you're earning interest on the principal plus interest on other interests that you've accumulated. So you have money making more free money. So as your savings grow, you're earning interest on a bigger and bigger pool of money, which is why we love it. It's why we think that it's magical. And I want to exemplify this, or illustrate it, I should say, in the visual that you see on the screen here. So let's say, if you can, hopefully you can see it. If you begin, let's say as an example, you begin investing $250 monthly, assuming the stock market average return of 10%, that's a profit of, drum roll please. Hopefully you heard that. Oh, there it is. A profit of $1.3 million after 40 years, which, I'm sorry, let me say that again, $1.3 million after 40 years. So I'm sure if I didn't have your interest before, I've peaked it since then. I want you to kind of keep this in mind, that let this be one of the motivators behind saving and investing, right? That you can take advantage of this compound interest. And if you want to be able to play around with this as well, Becky's going to share a link in the chat to an online compound interest calculator, which is actually the same one that we used here to generate this illustration, so that you can kind of play around and see how much you can save and benefit from the magic of compound interest. Perfect. Thanks, Becky. All right. Now, if you've ever wondered why you should save, and some folks do, let me give you 3 good reasons. So we're going to start the conversation here around saving. Reason number 1, having some money saved makes it possible to easily deal with a financial crisis. And it's not a matter of if, it's a matter of when. So having cash on hand to pay for unexpected emergencies like car repairs or broken phones, or even a loss of income, which could be on the more severe end of a crisis, right? Having cash on hand is going to make it possible to recover quickly and remain on track to meet your financial goals, short-term and long-term, which, speaking of, is the second good reason to save. You see that on the screen there, right? These short-term goals that you have, they might include buying a car, taking a vacation, or even just paying the security deposit on a new apartment, which all of these things are going to require that you have cash readily available. And I'm thinking a lot of you as students, the students who tuned in, if you're looking to live off campus next year, you want to make sure you have money ready to go for that security deposit or that move-in fee when it's asked of you, right? And now finally, the third reason why we save, you want to be prepared for periodic expenses, quarterly and annual expenses that they're occurring regularly. You know that they're coming, but they're not necessarily monthly. So sometimes they get missed out of our budget plans. And this can include things like insurance or tax payments. So I want to make sure that you're clear on all the good reasons why we save, how we benefit from putting a little bit of money aside here and there, right? So how does one do it? How can you save for all of these things that I mentioned and more? Because you probably have more reasons than just the three that I mentioned on the last screen, right? Well, it's going to require you to first get a savings vehicle where you can store your cash. And so this could be, as you see the bottom bullet points on this screen, it could be a free savings account, a high yield savings account, or a money market account that you open with your local bank or an online bank. Now, I want you to use the visual on the screen. I want you to think of your savings vehicle like a bucket. And from there, you're going to aim to regularly save at least 10% of your net monthly income from your paycheck or from whatever other income source you have. Eventually, you want to have enough money saved to cover at least 3 months worth of living expenses in case of emergencies, as well as money for your short-term goals and those periodic expenses. You want to make sure that everything is covered within this savings bucket of yours. Now, I will say, if you're finding it hard to remember to save for these things, and sometimes it can be difficult, there's a lot of clutter in our brains. I know, right? So if you're finding it hard to save regularly, I want to encourage you to turn on automatic recurring transfers from your checking to your savings vehicle to make it just happening instantaneously every month or whatever the frequency is that you set to make sure that your bucket is being filled to cover these expenses that you expect to have money for, right? Now, over time, you're going to see that savings bucket begin to fill and fill and fill and fill. And like with any bucket, at some point, it's going to begin to overfill. It's going to spill over. And that is to say that it is possible to put too much money into your savings bucket. And I'll explain why that is on the next two slides. So take a listen here, because you might be wondering, save too much? What do you mean, Sarah? Tell me more, right? At some point, you're going to begin thinking, as you're doing all this saving, right? You're going to begin thinking about the future and forming a plan to do all sorts of amazing and expensive things, right? These things like getting married and starting a family, buying a house, and eventually retiring. Like these are all things that I know I personally want to do. And I'm sure that some of you share in these goals too, right? So you've got your savings bucket. You're saving money in your savings account, you're earning interest, and the balance is compounding and growing exponentially. You're feeling really good. I'm all right. But then, boom, inflation strikes at a rate that is exceeding the interest you're earning in your savings account. And suddenly, now you're losing money because anytime your savings doesn't grow at the same rate as inflation, you will effectively lose money, which is like, ugh, like my heart, I can even feel like my own heart is pounding more right now. Like, this is really intense. Like, what are we going to do about this? Right. And the answer is to invest. And at this stage of the financial ladder, that fourth step that you saw on the last screen, planning for the future, I'm talking about wise investing so that your money will be there when you need it for the major expenses down the road. I'm talking about, in this case, retirement, where your goal is to have enough money to pay for expenses for the rest of your life, which is a great goal to have, right? Depending on your state of residence, I've seen figures that estimate a comfortable retirement will cost a person anywhere between $800,000 and $1.5 million, which is also just kind of like, whew, you think about that and you're like, that's a lot of money. So let's think of retirement as a number, not an age. and consider, well, where on earth am I going to, let me get my words right. Where on earth am I going to be able to generate that kind of return if I need $800,000 to be able to live comfortably in retirement? There are two options that you see here on the screen. You've got an individual retirement account, also known as an IRA, and on the right side, you see an employer-sponsored retirement plan. We're going to talk about the latter first. And I mean ladder with a T, Latter, the second one, right? So through our companies and organizations, most of us are going to be offered a 401k. That's a retirement plan. So most of us are going to see that. But if you're entering the world of public service, like I did, you might have access to a 403b, a 457b, or a TSP, thrift savings plan, or a pension instead, right? So most of us will see a 401k, but some of us might have a different retirement plan option made available to us, right? Regardless of the type, if you have access to one, I encourage you to take advantage and to contribute. Many are offered to you for little or no cost, and in some cases, your employer will even match your contribution dollar for dollar or something like 50 cents to the dollar, which is really just free money for you and your retirement. Now, in general, you should aim to put at least 15% of your income towards retirement as best you can, right? Any bit helps, but if you're looking for that kind of rule of thumb, I want you thinking 15% and taking advantage of employer match programs if they're offered to you. So how about an IRA though? We see that on the left side of the screen here. For an IRA, anyone with an income can open and contribute to this kind of account. There are two really common types you see here on the screen, traditional and Roth IRAs, and each has tax advantages, which we're going to take a look at here on the next slide. We're going to see kind of how these IRAs work. All right, so you contribute to a Roth IRA using after-tax dollars so that when you retire, you can withdraw from your account without incurring any income taxes on your withdrawals. Conversely, you contribute to a traditional IRA using pre-tax dollars, but when you retire, the money you withdraw from the account will be taxed at that ordinary income tax rate. So the key difference here is that the key difference between each is the timing of their tax advantages. So in this example you see on the screen here, each netted the same return at the end by the time of retirement, but that won't always be the case depending on your unique financial situation. So when trying to decide which IRA is best for you, I really do encourage you to chat with a financial professional at your bank or stop into our office for a one-on-one with a member of the Financial and Life Skills Center team. We're happy to talk with you more about how the ins and outs of these IRAs and what to be aware of before making a selection for yourself, right? So you've got this goal. So we're still in the frame of retirement. You've got this goal to have enough money to be able to pay for expenses for the rest of your life. And to do that is really going to require that you invest early and often. Okay. And so I want to illustrate that point further here. We've got three investor profiles on the screen here: Talia, Jess, and Nate. Okay. They're each investing a little bit differently, but let's take a look and see. And I want you thinking about who is going to be netting the highest return on their investment here. We've got Talia, who's investing $5,000 annually for 30 years with a total investment of $150,000. Jess is investing similarly, $50,000 annually for 10 years, a total investment of $50,000. And Nate is investing $5,000 annually for 30 years with a total investment of $200,000. Now, I want you to think about, or take a good guess, or maybe you know, and you're very confident in your answer, who here is netting the highest return. And I want you to tell me using the poll that pops up on your screen. I promise it's not a big math exercise. Oh, look at this. Oh, okay. I was going to see, do we have any variety coming through here? We do. We have answers all across the board here. I'm going to share these results in just a second. So take like 10 more seconds. And then I'm going to end the poll and share your responses out. Okay, so who is getting the highest return on their investment by retirement? by, in this case, age 65. All right, take a look. So we're kind of all over the place here, right? We've got some folks say Talia, some folks say Jess, but mostly folks are saying Nate. So those of you who said Nate, kudos to you. You got it. Nate is netting the highest return. Why? Why is Nate netting the highest return? And in fact, when you look at this closely, some of you who maybe thought, well, Nate's the highest, but Talia is going to be second highest. She'll have the second highest return on her investment. Take a look. Talia is only netting around $500,000 by retirement versus $600,000 for Jess and over $1 million for Nate. What's the biggest variable here, right? What is at play? Anybody got a guess in the chat? Beautiful. Beautiful. Yes. Time, right? Time is one of the biggest variables here. Time and how much you have to invest, right? So investing early and often are the biggest variables that I want you to be aware of. And it's not to create any feelings of stress if you haven't gotten started with investing, but hopefully creates enough healthy urgency to prompt you into investing further. And I'm actually going to dive into this and give you some information to start chewing on, right? So that you can be able to make some choices for yourself that allow you to really benefit from investing early and investing often. Excellent. All right, let's keep going here. So you're climbing this ladder to financial wellness. You've successfully climbed the first 4 rungs of the ladder. You have a budget that is accounting for saving for emergencies. It's accounting for your goals, those periodic expenses that come up irregularly. You're maxing out your contributions towards retirement. You are meeting all of your financial obligations, and you still have some money left over that is quite honestly burning a hole in your pocket. And you're wondering, like, what can I do with this? You know that investing is the best way to beat inflation, right? So what other options do you have at this 5th level to really grow your wealth, and how do you do it? All right, let's start with the how. So investing, it can seem tricky. It can seem scary. That is what a lot of you said at the very beginning of this presentation. It is confusing, scary, tricky, just it's not eliciting good feelings for some of us here. But I want to reassure you that you can break down investing into 5 simple steps, and it's going to really make it seem not so much as a daunting venture as you might initially think. And these 5 steps are: figure out how much you want to invest, open an investing account. From there, you're going to choose your investment mix, and as needed, you'll change it up over time, and then start to watch your money grow. Which, when I say it like that, it seems pretty simple, right? I want you to think of it like going out for your favorite meal. There's something that you do commonly, all right? Hopefully will reassure you about this investing process. So think of it like going out for your favorite meal. I'm going to use sushi, for example. I really do enjoy sushi myself. Maybe you do too. So you're deciding first how much you want to spend on dinner, right? There are different expenses or different degrees of sushi costs out there. So you're deciding how much you want to spend on dinner. You're deciding on a restaurant. You're going to pick your assortment of sushi for this jumbo sushi boat that you'd like to order. You have a little tuna, a little salmon tonight, but maybe next time you opt for crab and eel. Each time you enjoy your sushi boat regardless, because you know you've made the right choices to satisfy your appetite. The same goes for investing. You are going to pick, right, how much you're going to decide how much you want to invest, where you're going to invest, choose that investment mix for yourself. It might change over time. Regardless, it all should satisfy your appetite for investing. It should be able to work for you and the financial goals that you have for yourself. So the next few slides, I'm going to overview a few of the investments that you might add into your mix, which is going to include potentially stocks, bonds, real estate, and alternative investments. Now, no matter which type you pursue, it's important to keep in mind the following investing tips. It's really important that before you make a selection, you do your research, which is part of any investor's due diligence to judge whether something is a good investment or not. Also, your portfolio should be well diversified. So investing is risky. I'm sure you've heard investing is risky, and you don't want to put all of your eggs in one basket, so to speak. You don't want to lose everything all at once. So you want to have a mix of investments. You want to have a diversified portfolio so that you're able to mitigate that risk. You also want to look into playing the long game. The stock market, it fluctuates. You are going to see on a daily basis fluctuations that look a little bit like this. That's very normal, right? But over time, those fluctuations tend to level out and you see an upward growth over time. The key here is that, when investing for big long-term goals, you give yourself enough time, like we saw in the Nate example on the earlier screen. Now, finally, you can start slow and steady. It is okay to take your time and form a plan. There is no reason to get caught up in an investing hype if you're not comfortable. And you should listen to yourself, listen to your own intuition, right? I mean, there may be opportunities or times where you might want to um, step out of that space of comfort, right? But certainly, if you're losing sleep at night over investments, like that should give you pause, right? And so you want to kind of take time, slow down, step back if you need to, and make sure you enter into the world of investing when you are comfy and ready to do so. You feel prepared. Hopefully, this presentation is helping. So let's first talk about stocks. We're going to talk about individual stocks. When you purchase a stock, you are gaining partial ownership in a company. You make money from stocks in one of two ways. You can receive direct payments from the company to shareholders, and that's known as dividends, or you can sell your stock after the price has appreciated or gone up. Now, the thing about stocks is they can be relatively easy to buy, which is nice, and they offer potential for high returns. So those are your pros, but they do require research. When we're talking individual stocks, they require research and are moderately risky as their value can fluctuate as you see the stock market fluctuate, right? So you might want to find, or you might find, I should say, individual stocks then taking you for a ride on a bit of an emotional roller coaster, right? Just like you see the stock market rising up and down, you may see that happen in the value of your stocks, and that might be taking you on an emotional roller coaster you maybe weren't necessarily expecting. Now, one way to get off or at least slow down that emotional roller coaster while still investing in stocks is through mutual funds, index funds, or ETFs. Those are exchange traded funds. These are professionally managed funds that pool together money from folks to invest in securities like stocks and bonds. So I want you to think about it this way. I want you to think about these funds in this way. I'm going to go back to the sushi analogy. Investing in individual stocks versus a mutual fund is the difference between you shopping around for your own sushi at the grocery store, getting your own ingredients and trying to assemble them in your kitchen at home while you're watching a how-to YouTube video, right? Which may or may not result in some tasty sushi. Or you are opting to visit a restaurant to have a sushi master prepare that meal for you, and it's likely to be pretty delicious. So instead of trying to pick the best individual stocks and bonds for yourself, you can choose a mutual fund in which a professional money manager has already assembled a combination of stocks and bonds that is right for you and your financial goals. And so for this reason, investing in a fund can be easier than investing in individual stocks, and it can also help to mitigate your risk of losing money. So I want you to keep in mind this benefit or potential benefit for you of investing in mutual funds, index funds, or ETFs. All right, now let's move on to bonds. So check that risk meter at the top of the screen. You're going to see a little change up there, right? We're talking bonds, and bonds represent a loan made by an investor to a borrower, which is typically a government or a corporation. So think of it like an IOU in which the government or that corporation is borrowing your money with the promise to repay the balance in full plus interest. Now, keep in mind that bonds can take upwards of 30 years to repay, right? There's a variety of bonds out there, but some of them take up to 30 years to repay. They're generally less risky than stocks, especially treasury bonds, because they're backed by the federal government. But with this lower risk also comes a lower return since most bonds pay a lower interest rate. So because they offer that fixed rate of return over a specific period of time, though, they can be the key to a balanced investment portfolio mix. So you don't necessarily want to discourage or what's the word I'm trying to say, don't count bonds out, I guess is what I'm trying to say, right? Kind of keep them in consideration as you're building out your investment portfolio because they do help to bring a balance. Now, when we talk real estate, so switching gears, when we talk about real estate as an investment, we're talking about purchasing land and any permanent structures attached to it, like a house, for example. So money can be made from real estate either through a tenant making payments to the investor, AKA that landlord, like you see in the visual, or by the investor, AKA the home buyer, selling the property after it has appreciated in value. So real estate investing in the context of home ownership specifically, and I'm going to talk about home ownership because I think that's something that a lot of us are eager to do one day, right? Real estate investing in the context of home ownership promotes wealth building by acting, number one, as a forced savings mechanism, and then number two, through home prices rising over time, where you could sell that property and profit from it. And what's really cool is by extension, it also is promoting intergenerational wealth building, meaning that a person who has that house is an asset to them, and they can pass that down to their child, who will in turn benefit from having that asset now for themselves, right? So it's really exciting stuff when you think about it. Now, for anyone who's not interested in or able to invest in a tangible piece of property, the alternative is to invest in a REIT or a real estate investment trust. Now, REITs allow you to invest in large scale income producing real estate. So like rental properties, for example. They are companies, these REITs, they're companies that own and sometimes even operate the properties. And we're talking office buildings, potentially malls, apartments, hotels, among a few different other things. Now, what's kind of cool about REITs is that they can be bought and sold on the stock market, and they act in that sense similarly to stocks, and that you can make money from them through dividends and selling after price appreciation. So you can see how this is a little bit more accessible rather than trying to buy a whole house for yourself or a whole piece of property for yourself. On the upside, REITs offer diversification for your investment portfolio, and they often are paying those high dividends. But on the downside, they are typically pretty research intensive. There's a lot to know here, and their value can fluctuate, especially as interest rates are on the rise. So REITs and real estate in general, they are moderately risky investments. And I want to kind of keep that in mind, bring your attention back to that risk meter that is for illustrative purposes only, right? But it kind of gives you an idea of what am I looking at here? Sarah's talking about real estates and REITs. How risky is this relative to some of these other investment vehicles that she's described? All right, now opposite from bonds on this risk continuum are what we would call alternative investments. These are investments beyond traditional bond and stock offerings. These are things like cryptocurrency, NFTs, collectibles, or commodities like gold, oil, silver, coffee, copper, right? These types of investments are not always subject to governmental regulation and oversight, and they are often very complex. You can think of it kind of like the wild, wild west of investing. I think we would describe these types of investments as fairly illiquid. So when I talk about something being illiquid, I'm meaning to say that it is not easily sold. And with these alternative investments, they can be hard to value at times. So they get a little tricky, which is why we call them alternative. And if you look at that risk meter, the risk meter is like practically off the charts in terms of high risk here, right? If you have ever perused eBay, you will know what I am talking about. There are things for sale on eBay that were an investment for the person who's selling it, but they might not be getting any bites. It might be something that is hard for them to sell and profit from, right? Now, if you have interest in alternative investments, and high likelihood there are some of you out there who want to know more about cryptocurrency, you want to know more about NFTs, which are non-fungible tokens, I really encourage you to, number one, reflect back on the tips that I shared earlier to be able to do your research, to invest in these alternative options, but doing it full well, knowing what you're getting yourself into, right? And taking the time, if you can, to talk to a financial professional. If there is somebody that you have worked with in the past, or somebody that your family knows, an expert in these areas of alternative investment, please do communicate with them. I want you to feel really confident in moving down this path of alternative investments because they can be so risky. Yeah. Or yeah, Beanie Babies. I just saw Beanie Babies pop up in the chat. Are you my dad? 'Cause my family, they sure did get on that Beanie Baby hype, right? And we had lots of Beanie Babies in our basement for a long time, and had then at some point donated lots of Beanie Babies to the Goodwill, right? So yeah, I mean, we talk about collectibles too, right? That's an alternative investment that you want to be really, really thoughtful about making before you make it, right? Good, good, good. Okay. All right, now whether you choose to invest in stocks versus bonds versus real estate, alternative investments, a mix of that, or really anything else, that's going to be largely influenced by your level of risk tolerance, which can range, as you see here on the screen, from conservative to aggressive. And it's influenced in large part by factors like your age, which also is suggestive of your time horizon, your goals, your monthly budget, your debts, your family situation, your overall attitude towards money. There's a lot kind of at play that's influencing where you feel like you would fall on this continuum of risk tolerance. So more conservative, less risky folks, they might have an investment portfolio that looks a little something like this, mostly bonds with some stocks or cash equivalents. These folks are probably going to include some first-time investors, folks who are just kind of getting their feet wet and they're building up their risk tolerance, their comfortability in that space, right? Or someone with a short time horizon, meaning that they'll need their money sooner rather than later. So somebody who is pretty close to retirement, but they're just maybe getting started with investing, or they're taking a look at that investment portfolio, making some adjustments to it, right? On the opposite end of the spectrum, more aggressive, risky folks, they're going to have a greater makeup of stocks with a sprinkling in, as you can see, of alternative investments, bonds, and cash. So there's greater risk. They're more aggressive with that greater risk. These folks tend to be more experienced investors, or someone who's got a really long time horizon, someone like Nate, who starts investing early and has got 40 years before retirement, right? And they're able to weather the ups and downs, the volatility of the stock market over several years, if not several decades. So you've got then, of course, the other profiles that are in between. And I encourage you, if you want to learn more about these profiles and get a sense of kind of which you feel like you fit into, we've got a link from FinMasters. I think Becky's going to share it through the chat with you all. They have a little risk profile test, which of course is not the end all be all, right? But it just kind of gives you a place to play around, look at levels of risk tolerance, get a sense of what defines conservative versus aggressive investing, or kind of where you fall on this continuum of risk tolerance. Thank you so much, Becky, for sharing that. I appreciate it. All right. So that's one place you can kind of go to begin thinking about you as an investor, but that's not all, right? Like, I've given you a lot of information here, a whole ton. This is really a major presentation, but it doesn't end here, and you can continue to learn more about saving and investing vehicles and saving and investing strategies by tapping into our other resources, as you see on the screen here. We've got follow-up modules on saving and investing that you can explore. We've got one-on-one appointments that if you are a student here at Penn State, I really hope that you'll consider meeting with us one-on-one as you decide to take a deeper dive into your finances and you begin to build for yourself a savings and investing plan if you don't already have one, or even if you do have one and you're looking for some thoughts on it, right? You're looking for some more information about these investment vehicles, right? Come and chat with us. Becky's on the call today. She is our main one-on-one person, right? She oversees that line of programming here at the center. Becky, how often are you meeting with students about saving and investing, would you reckon?
I would say saving more than investing, probably, because saving is a step you need to take generally before investing. Because if you don't have an emergency fund or any of those plans made, you probably should not be diving into investing quite yet. But I would say a huge majority of appointments we talk about like saving and planning for that future. And then a smaller percent of that would be investing specifically.
Mm, okay. All right. Well, you can make appointments to meet with Becky or another member of our team. We've got appointments via Starfish. You can access that through our website. In fact, Becky, if you're able to throw our website link back in the chat for anybody who joined a little bit later, if you are a student and you want to make that appointment, please do so. We are here 5 days a week, fall, spring, and summer to meet with you. This is not at any additional cost to you. So I do hope you take advantage of that resource to be able to learn a little bit more and do a little bit more work in this area of your personal finances because it is so very, very important. I will also highlight too that we've got workshops coming soon. Our director, Julie, is on the call and she's been doing a lot of really wonderful work around these workshops that are hands-on, small group, and you can expect them to launch later in the spring. If you know a community learning space where you're actually going to dig into your finances is like the best place for you to be, then by all means, please, sign up for those workshops as soon as they become available. Becky's also going to share in the chat a link to a survey letting you let us know what you thought about this presentation. And as part of that, you can sign up for our listserv. And so you'll be one of the first to find out when those hands-on workshops go live. So really exciting stuff coming down the pipeline here. And all to your benefit, right? All right, so that's everything that I have for you all today around saving and investing. We definitely have some time for questions, so we'll take those in just a minute. But I wanted to say first to anybody that has to leave, thank you so much for taking the time to join us today. We're going to be back here in 2 weeks on November 1st to talk about banking basics, which is kind of a little bit of a back step, right, from today's presentation, or a nice addition to today's presentation. So if you have more questions about banking, you want to explore savings vehicles a little bit further, I highly encourage you to tune into that. Or if you're not able to, check out that YouTube page that we have now, because the recording will be up for you to be able to pull up on demand 24/7 whenever you need. Okay. All right. Thanks, everyone.